Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz. Let's get across what we've seen overnight. Global equity markets mostly lower, with investors weighing up a raft of central bank meetings and stalled peace talks between the US and Iran. On Wall Street, however, the S&P 500 and NASDAQ managed modest gains to extend their record highs as investors geared up for a big week in earnings results. Well, the S&P 500 is now up more than 100% since the bull market began in October 2022, and analysts now see aggregate S&P 500 earnings growth of 16.1% year on year. Stocks specifically, Verizon advanced following the telco's annual forecast hike due to stronger than expected subscriber additions there. Domino's Pizza shares slid after the food delivery chain forecast softer growth in annual US and international same-store sales and strained consumer sentiment amid fierce competition weighing on demand. Nvidia extended the price session surge and reclaimed a market valuation of more than $5 trillion, while Apple and Amazon each slid ahead of their results this week, and Atlassian also fell. Microsoft shares fell in early trade before recovering, with it no longer having exclusive access to OpenAI's models and products, which will allow the ChatGPT maker to sell tech across rival cloud platforms. Other top gainers included SanDisk, Micron Technology, and Albemarle. Well, President Trump discussed a new Iranian proposal on resolving the war with his top national security aides as the conflict remains in a stalemate. Iranian sources revealed the regime's latest proposal, which would set aside discussion on Iran's nuclear program until the war is ended and disputes over shipping from the Gulf are resolved. Well, US Secretary of State Marco Rubio said he thought Iran was trying to buy more time, saying we can't let them get away with it. Meanwhile, in Washington this week, Federal Reserve policymakers will gather in what may be Jerome Powell's last meeting as head of the US Central Bank. While interest rates are expected to remain on hold, the policy committee will have to decide if it's time to acknowledge the possibility of hiking borrowing costs if inflation continues to accelerate, with Fed Governor Christopher Waller saying the longer energy prices remain elevated and the Strait is constrained, the greater the chances that higher inflation gets embedded across a wide variety of goods and services. Various supply chain effects start to emerge, and real activity and employment start to slow. Well, US Treasuries have eased after softer than expected front-end auctions. The US 2-year yield at 3.81%, the 10-year up to 4.35%. Australian 3-year government bond yields rose to 4.71%, the 10-year up at 5.05%. US dollar index down slightly on the day, the Aussie trading at 71.9 US cents. Oil prices have surged again to a 2-week high as peace talks between the US and Iran stalled, and shipments through the Strait of Hormuz remain limited, keeping global oil supplies tight. Brent futures rising 3% to 108 US a barrel. Gold has fallen to $4,680 an ounce, and a Reuters poll of gold analysts has forecast the median price of $4,916 an ounce for 2026. Copper was little changed, as was iron ore at 109 a tonne, and Bitcoin has fallen to close to 77,000 US dollars. So let's get across those market moves now. Steve Sosnick, Chief Market Strategist at Interactive Brokers, joining us again as he does on a Tuesday. Steve, welcome back. And at the risk of sounding repetitive, the market just wants to go up. I mean, that's certainly the case on Wall Street at the moment, isn't it? But it is a big week to consider for investors, certainly with some very big mega cap tech stocks reporting. Plus, of course, you have the Fed meeting. And then in the background of all this, of course, is the war, which continues.
Well, you pretty much summed it up there. I don't think, that's it. The market does just want to go up. I mean, the question I've asked people continuously is, if I told you about a month and a half ago that we would have, call it 40 basis point higher 10-year yields, we would take 2 25 basis point cuts off the table, we would have oil $35, $40 higher, and yet we'd be at all-time highs and never looking at down days, or seemingly, you'd think I was insane, and you'd be right to think that. But that's not what we have right now. It's quite unprecedented to see the type of moves we're having, particularly in the semiconductor stocks, where we've had 18 straight up days. That streak was broken today. in spite of Nvidia's rise. But you've had Nvidia rise $1 trillion in market cap in about a month. You had the semiconductor sector re-rated, where it's about 40 some odd percent. I forget exactly, 40 some odd percent higher in the course of less than a month. Were we that mispriced before? Are we mispriced now? There's so many moving parts out here, but my thesis here is I don't think it matters, because I think about the way that stocks react when they get even the slightest bit of good news about the prospect for peace talks in the Persian Gulf. Granted, we want peace. Let me be explicit about that. But the interesting thing is we get this almost bait and switch. We get, oh, peace talks are coming, and then we rally, and then, oh, by the way, nobody's coming, or nobody's showing up, or we're not sending anybody, and we don't sell off. So we're almost in love with the idea of, we're such at the point of buy the rumor that, I wonder what happens if it's time to sell the news. Bonds and oil have stopped falling for this. Well, yields have been rising. Each time, we don't get a deal, oil continues to rise as the blockade remains in place. Stocks shrug it off.
All right, well, let's put the war and its outcome to one side, if you like, perhaps as markets are doing right now. Look ahead to earnings. As I mentioned, there's some key results coming to us this week. Look, a lot of these gains we're seeing on Wall Street is driven by those mega cap tech stocks. So how pivotal will these results be, do you think?
I think they have the potential to be quite pivotal. The problem is when it comes to individual earnings, I'd be lying to you if I told you I had a great sense of, whether Microsoft beats because of Azure's, bottom line, or is AWS going to power Amazon higher on Wednesday. I don't have that kind of clarity. So I want to think a bit more broadly from a strategic point of view. On Wednesday, with Fed meeting, at 2 o'clock Eastern time, U.S. 2:30, you have the Fed press conference. It looks like Warsh is going to be confirmed by the Senate Banking Committee beforehand, which would set the stage for Powell to basically treat this as his last hurrah, so to speak. So I think the Fed meeting, no one's expecting anything from it, and in terms of rate cuts, rate moves, I think it's basically going to be his valedictory address or his graduation speech or whatever it is. I still don't think he's leaving as governor. There'll be a lot of questions about that. If I were his lawyer, the way that the statement announcing that the prosecution was ending left it open for more prosecution, I wouldn't be going anyplace anytime soon. Because they pay his legal bills, basically. The Fed would. So I'm not going anywhere. Then an hour and a half later, you start getting 4 of the Mag 7 earnings rolling out, and the fifth to come the following day in Apple. That leaves the possibility for immense volatility. If these things move in roughly in sync, that's 20% of the S&P 500 at one time in one direction. But life doesn't usually work that way. We'll probably have some go up, some go down, which means from an index point of view, it probably washes out. Again, this is just a best estimate, or just, sort of past performance being no guarantee of future results. That tends to be what happens. But then the final thing is, what are they going to say about AI spending? And that, to me, has the most bearing for again, the semiconductor index that's up 40 some odd percent in a short period of time. It's been predicated on the idea that AI spending is just blowing these earnings out of the water. They're beating on earnings, they're beating on guidance. This is terrific, and I understand it. We saw with Texas Instruments, with Intel, 2 companies that had been, one was a kind of a laggard, the other one was literally almost left for dead. And they both had immense rallies last week. If we get a whiff that the hyperscalers are not increasing their spending, let alone, eyeing ways to, control it a bit more, that's very problematic for the semiconductor sector, because I think to a certain extent, the people who've been rallying the semis so hard are expecting to hear that more money is going to be flowing their way. And I don't know about that, but if I were hedging this earnings announcement right now, I would probably be looking to do it in stocks, the semiconductor sector, rather than maybe even the specific stocks themselves, or QQQ, or SPY, or the type of things that are more obvious hedges for big slug of earnings of this nature.
I mean, Steve, we often talk about complacency on the market. I mean, in terms of that massive capex that we're seeing come through, is it the view, and perhaps do you think this is misplaced, that the market thinks, well, this is money well spent, it's all going to pay off?
Well, we've kind of been of two minds about this. I mean, we meaning sort of the royal we, the market as a whole. Originally, for a while, it was if you spend money, great. Because, and to be fair, if you don't spend the money, if you do spend the money, I can't assure you that you'll win the AI race. If you don't spend the money, I can pretty much assure you that you won't. So everybody was all in on this, and for understandable reasons. Then we hit a point where people started to question, is this money being well spent? Is this actually going to get a rate of return that's acceptable? And, particularly, we saw the software stocks get whacked on the back of AI. We do have to consider the idea that, the hyperscalers, which had phenomenal balance sheets and income statements, basically huge margins, immense cash flows, seemingly endless earnings growth, with very few assets, as relatively asset light businesses. Well, that's changing because they're spending billions upon billions of dollars on data centers and borrowing lots and lots of money to do it. So this cash flow that's been spewing out of these companies is just not coming anymore. So this will be an interesting choice. Are investors going to once again focus on profitability and whether the money's going to be well spent, or is it going to be back to the damn the torpedoes, let's just spend it and worry about how it's spent later? The market's been of two minds about it, sort of leaning back toward the just spend it and worry about it later. Let's see what happens this time around.
Steve, thanks for catching up with us and getting across what you're seeing in markets. Thanks for joining us on Interactive Brokers. Have a great week.
You too, Andrew. Take care.
Right, let's turn our attention to the local market ahead of the open here on this Tuesday. Looking for a fairly hefty fall there to begin, down 0.7% according to the S&P ASX 200 futures. And look, we've got a raft of quarterly reports to get across today as well. Join us for that in just a minute for the open.